Hello, my name is Tej van Pettinger from Economics Help, and today we're going to look at the winners and losers from inflation. Inflation is when there's a sustained rise in the price level, an increase in the cost of living. And so when there's inflation, the value of money decreases. And the higher inflation is, the faster the value of money will decline. So to give a very simple example, supposing you have $1,000 and you keep it under your mattress in cash, then if there's high inflation, this money will be able to buy less goods and services than it used to. So the first big losers from inflation are those who have savings, especially savings in cash. Now, if you have money in a bank and the interest rate is higher than inflation, then savers may be protected because the interest rate you get from savings is higher than inflation. So actually you're protecting your value of savings. However, if we look at the past few years, we've had very low interest rates, close to zero in many countries. And so savers who have money in a bank are getting very poor returns. And so inflation of even 4 or 5% is still quite significant for reducing the value of their savings. And this may hit those who rely on savings more than others. For example, people who are retired, living on their savings, getting a small pension. They may experience difficulties when inflation is high because their savings are going down. Another big loser from inflation could be exporters if they're struggling to compete internationally. If UK inflation is higher than other countries, then the price of British goods are going up higher than others, and so therefore there'll be less in demand because other countries would tend to prefer cheaper imports and not the expensive British exports. So countries with high rates of inflation may see lower export demand. And also, high inflation may cause a depreciation in the exchange rate, because if British goods are less competitive, there'll be less demand for British goods and therefore less demand for buying pound sterling. So this would cause a value to go down, and a falling exchange rate will make imports more expensive and kind of create additional problems, additional inflationary pressures. Another big problem of inflation is that when it's high and variable, businesses will find it more difficult. And in particular, they dislike the uncertainty of high inflation. When inflation is high, they may be uncertain about future costs, about future revenues, and so they tend to cut back on investment. And countries with high rates of inflation over a period of time tend to have lower rates of growth, lower rates of investment. Now, the potential winners from inflation could be those who owe money. Supposing you owe £1,000, but then there's high inflation and this causes higher nominal wages, then over time you'll be getting more money to pay your debt back. So if you have a fixed interest rate mortgage or fixed rate on your borrowing, then high inflation, as long as you get higher wages, will make it easier to pay it back. So this is why we often say that inflation is good for borrowers but damaging for savers. However, it is worth saying that if you on a variable mortgage payment or a variable interest rate loan, then if inflation is high, it's quite likely interest rates will go up. And so even borrowers will have to pay a higher interest payments because of the higher inflation. Another potential winner from unexpectedly high inflation could be the government, or a government with high public sector debt. Because a good example is actually in the 1970s, where governments like the UK and the US had quite high levels of government debt. And they were selling bonds to finance it. But then in the 70s, inflation was higher than expected. So many bond investors saw the value of the bonds go down, and it was easier for the government to pay back their debt, because with inflation, the government gets more nominal revenue, and they were able to reduce the real value of their debt. So it's a bit of a kind of a blessing for some governments, in that the high inflation of the 70s did reduce real value of debt. But it was at the expense of those who bought bonds, and they found that the inflation rate was higher than the interest rate they got. When looking at the winners and losers of inflation, it's important to look at a few factors. So one factor is the extent to which wages keep up with inflation. So if you have a period of stagflation, if you have a period of rising prices, but wages are not keeping up, then this inflation will be very damaging to living standards for workers. So for example, at the past 10, 15 years, we have often had a situation where inflation rate has been higher than nominal wages. So this means that those in work are seeing a fall in the real value of their wage. Their purchasing power is decreasing, and so inflation is quite damaging. Now, in the 1970s, when we had high inflation, generally speaking, wages were keeping up with inflation. In fact, wage growth was one of the causes of inflation. So in the 1970s, this wasn't so much a problem, because at least wages were keeping up with inflation. But at the present time, and the past few years, even though inflation has been relatively moderate, 4-5%, this has actually been quite damaging inflation, because many workers haven't seen nominal wages keep up. Also, it depends on the rate of inflation. So for example, if inflation is in the range of 2-4%, then this is very rarely a big problem, because the economy is used to this kind of moderate rates of inflation. It's easy to mitigate the effects of inflation when it's quite low. But if you start to get hyperinflation, where inflation is over 1,000, 2,000%, then the costs of inflation become much greater, because you have the costs of changing prices every day, you have tremendous uncertainty, and savers can see their savings completely wiped out. So if you look at countries like Weimar Germany in the 1920s, the inflation there created huge psychological damage, and economic damage, of course, because money just became worthless. Middle class people who had savings saw it completely wiped out. And this kind of reverberated through German society for many decades, and of course was even a factor in the kind of end of Weimar Germany and the rise of Hitler in the early 30s, because inflation was so damaging, and it kind of led to a psychological blow to the country. And if you look at Zimbabwe or Hungary, other countries that had very high inflation, then many normal economic circumstances break down. It's also worth bearing in mind that when you get this kind of hyperinflation and money becomes worthless, not everybody will lose out, because if you own land, if you own physical wealth, then you can be insulated against the effects of inflation. But it is going to cause this big distribution from those who don't have wealth to those who do. So when inflation is very high, it's good if you can own gold or property, land, something with a physical value but isn't completely destroyed by inflation.